Welcome to this comprehensive guide on growth versus value stocks. These are two fundamental investment approaches that every investor should understand. Growth stocks focus on companies with high potential for expansion, while value stocks target undervalued companies trading below their intrinsic worth. Throughout this video, you'll learn the key differences between these strategies and how to choose the right approach for your investment goals. Growth stocks represent companies expected to grow their earnings faster than the overall market average. These companies typically exhibit high revenue growth and consistently reinvest their profits back into the business rather than paying dividends. They often trade at higher price-to-earnings ratios because investors are willing to pay a premium for their future growth potential. Common characteristics include minimal or no dividend payments, as these companies prefer to use capital for expansion and innovation. Growth stocks are commonly found in specific sectors that are experiencing rapid innovation and expansion. Technology companies, particularly those in software and cloud services, represent a major category. Biotechnology firms working on medical innovations also qualify as growth stocks. Other prominent sectors include electric vehicles and sustainable transportation, software as a service providers offering enterprise solutions, gaming and digital entertainment companies, and e-commerce businesses transforming online retail. These sectors share a common theme of disruption and rapid market expansion. Value stocks are companies trading below their intrinsic worth based on fundamental analysis. These are typically established businesses with stable operations, but temporarily undervalued by the market. They generally have lower price-to-earnings ratios compared to growth stocks, indicating they're trading at a discount. Value stocks regularly pay dividends to shareholders and maintain stable cash flow from their operations. Investors in value stocks believe the market has overlooked these companies, and their true value will eventually be recognized. Value stocks are predominantly found in mature, established industries. The banking and financial services sector is a prime example, offering essential services with steady demand. Utilities companies providing electricity, water, and gas are classic value stocks due to their predictable revenue streams. Manufacturing and industrial production companies often fall into this category. The energy sector, including oil and gas companies, telecommunications providers, and traditional retail businesses selling consumer goods are all typical value stock sectors. These industries are characterized by stability and consistent performance rather than explosive growth. Let's examine the key differences between growth and value stocks across several important metrics. The price-to-earnings ratio is typically high for growth stocks and low for value stocks. Dividend payments are minimal in growth stocks, but regular in value stocks. Risk level tends to be higher for growth stocks compared to the lower risk profile of value stocks. Volatility is also a distinguishing factor, with growth stocks experiencing high price fluctuations while value stocks show moderate volatility. Understanding these differences is crucial for building a portfolio that matches your risk tolerance and investment objectives. The growth investment strategy is best suited for long-term investors who can weather short-term market fluctuations. It requires a higher risk tolerance since these stocks can be volatile. The primary focus is on capital appreciation rather than income generation. However, there are important considerations to keep in mind. Market timing can significantly impact returns, as buying at inflated valuations can lead to poor performance. The higher volatility means prices can swing dramatically. Additionally, this strategy is research-intensive, requiring constant monitoring of company performance and market trends to identify the best opportunities. The value investment strategy appeals to conservative investors seeking stability and income. It's ideal for those who prioritize regular dividend payments and prefer a patient, long-term approach. Important considerations include the risk of value traps, which are stocks that appear cheap but remain undervalued for good reasons. Value stocks typically experience slower price appreciation compared to growth stocks, requiring patience. Fundamental analysis is absolutely key to success, as investors must thoroughly evaluate company financials, management quality, and industry position to distinguish genuine value from problematic businesses. Many successful investors combine both growth and value stocks in their portfolios to create a balanced approach. This diversification strategy helps balance risk and reward potential across different market conditions. A mixed portfolio reduces overall volatility, as growth and value stocks often perform differently in various economic cycles. This approach allows investors to capture opportunities in different market cycles, as sometimes growth stocks outperform and other times value stocks lead. Additionally, combining both strategies provides a mix of income from dividends and growth potential from capital appreciation, offering the best of both worlds. In conclusion, the choice between growth and value investing should align with your specific financial goals and personal circumstances. Consider your risk tolerance carefully, as growth stocks require accepting higher volatility while value stocks offer more stability. Your time horizon matters too, with longer timeframes generally favoring growth stocks. Both approaches have proven track records of success over time, with legendary investors finding wealth through each strategy. However, diversification remains key to long-term investment success, whether that means combining both approaches or diversifying within your chosen strategy. The decision is ultimately yours, based on your unique financial situation and investment objectives.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.